Hello and good morning. It's Jeffrey Cohen, Chicago Quantum, U.S. Advanced Computing Infrastructures, Inc. Got a lot to talk about today. It's Friday. The market is lower. Now, we have been betting on a lower market with our own money for the past 3 weeks and kind of lost our shirt. That's why I'm wearing a Vasco da Gama Brazilian shirt, because I'm going to look for some luck today, right? I was looking for a bit of a crash today. We're not seeing it, but we are seeing prices lower. And honestly, so we're going to talk about a lot of things, but just to kick it off, volatility of stock prices is dramatically lower than I've seen it pretty much since I started looking at stocks, and definitely since I started running the model. So if you're waiting for a big day, if you're waiting for a crash, it's just not happening. Historically, stocks for the past year have been moving less and less each day. And let's be honest, the Dow, the NASDAQ, the S&P 500, those are indices that are designed to reduce volatility because they're market cap weighted, because the largest companies have the largest position. The largest companies move the least. And so S&P 500, you're really investing in like 30 or 40 companies, which are so large they're hard to move. And so, when I see the S&P down 1%, the NASDAQ down 1.5%, it reminds me of time like in the old days around COVID and after COVID, where stocks were moving 1, 2, 3% a day. We haven't seen that. And so we're going to talk about a few things. We're going to talk about top 10 drivers. By the way, we subscribe to Bloomberg. Yay, thank you, Bloomberg. They do not pay us for that little call out, but honestly, I like Bloomberg. Bloomberg's pretty cool. And so let's talk about the top 10 drivers. We have been cleaning up our website like crazy business. By the way, we're down to 8 drivers because I realized 2 of them are 7 drivers. 3 of them just didn't matter. And so we're going to talk about that. But just looking at the overall market is looking weak today. These are just stocks that I happen to have looked at. These are not stocks that we necessarily own or don't own. I do have a position in one of them, but I'm not going to call out any stocks specifically because I don't want to move markets. But we're going to talk a bit today about like Rigetti and ionq and the quantum companies. You can see one green name, which is Affirm Holdings. Affirm is a subprime lender. They actually, not only do they make the loans through banks and other companies, but then all the loans that are made, they take and they put back and they hold the risk. So you're talking about $12 billion 2 years ago, $16 billion in the past year. Probably looking at 20 to 30 billion now. Hard to imagine they could lose money when they're charging up to 36% interest. That's nice, right? I wish I was earning 36% interest. But what does it cost them to raise that money and to manage it? And what happens if there's a bad month and people just decide not to pay back the loans that they took on that bicycle they bought or that airline ticket? Look, the trip's already done. They just might not pay. So right now the market loves Affirm, loves it, loves it, loves it. It's been up. The market is not necessarily loving Bitcoin at 26.4. The market is definitely not loving UPS. I thought UPS, did a good job there, right? They conceded to the union demands. They increased their cost structure by 3.3% a year for the duration of the contract. And so you figure they're just going to raise prices. Inflation's through the roof. What's another 5-6% on UPS bills? But if the consumer's suffering and if markets are dropping, then maybe people will buy less. And now UPS has 3% higher costs, but maybe 3% less shipping. So now they've just destroyed their profit margin. I don't know. Maybe I'm crazy. So what are we going to talk about here? We're going to talk about short-term interest rates. What I keep hearing from people is that short-term rates are not moving. And probably true, right? If I look at today, right? So what about the auction results right now? Today's auction results. Maybe there was something, right, that's relevant here. I think it's important that you go right to the source because I don't know. I think there's a lot of misinformation out there. So we're going to look at 3 month, 6 month. We're going to look at the most recent competitive results. And so 3 month investment rate is 5.477%. So 5.5% on 3 month money. And anything that was offered at, hey, look, I'll take 5.315. Everyone below that got filled. So 5.5. Let's look at 6 month, which has been running a little higher than the 3 month lately. Investment rate of 5.54. In fact, this is what we're using in our model. And 5.3% was a high rate. So, look, a lot of people bid 5.2 and they got filled. A lot of people put in 5.28. But anyone who bid 5.3 or lower got filled. And let's look at this. They traded... They sold $63.7 billion in 6 month money, and they still had to pay 5.3%. So it's a lot. So short-term rates are higher. Okay, I got that, Jeffrey. Thanks, Jeffrey. I got that. How about long-term interest rates? How about the 10-year Treasury notes? So what I like to do there is look at the CME group, U.S. Treasuries, and see what I get here. So the 10-year Treasury is at 109.165. That was 109 and a quarter the last time I looked, maybe a day or two ago. So the yields are slightly higher, not a lot higher, but slightly higher on the 10-year. And so I look at that and I think, okay, I got it. It's not much. So I'm not seeing a big move in the 10-year. Stock price variance, I pulled this up for you guys. Some of you need to start buying our run so I can get paid. I just run it for myself at this point. But what you'd find, by the way, Intrinio had some issues with the market data last night. It didn't stop us from running. We still had 3,020 good stocks, but 3,018 just had some market cap issues. But you're looking at a variance of 4.18. Now, I updated it yesterday. It was 4.21. So when volatility, when stock price variance of 3,000 stocks goes down like this every day, what that really means is that in the short term, there's less and less and less variance. So you shouldn't be seeing the S&P 500 fall 1.2. You shouldn't be seeing the NASDAQ fall 1.6 because stocks just aren't moving. It drives me crazy, right? I bought some puts. Again, I'm losing everything. They're going to expire today out of the money because the variance just isn't there. I was betting on a variance uptick. You're just not seeing it. And so the VIX should also be lower. So the VIX is actually the price of volatility. So Jeffrey, where are we at here with the price of the volatility? Well, according to this, we're at 13.5, and that was yesterday. If I look at the futures, it's showing 13.95. Okay. Where am I going to find that? Let's look at the dashboard for the VIX. We're at 1365. I'm going to save that one. Stick it into the daily run here. So I can look at it every morning, my morning look. So you can see it was low this morning. It was down. It was under 13 handles. It was 1271. And now it's 1366. A 1 point move is a lot. It's a lot at 6.5%. But it's a lot in notional terms because I'm not surprised to see the VIX down because of stock market volatility, stock market price variance being down. But then I struggle because where does it lead us, right? If there's less risk in the market, then that's good for stocks. It's good for stock prices. Look at that expected return if you bought and held 3,018 stocks, all the stocks, including the dogs, including stuff that's like foreign companies listed in the U.S., and including profitable companies, you're expected to earn 13.75%, and that CQ&S power in the model says that return is much more important than risk right now. So net, variance is lower, that's good. Interest rates are rising a little bit, short term rising a little bit, which is bad for stocks. Now the US dollar. The US dollar has been on fire. Let's see if there's anything here with Bloomberg. I think I got a page on Bloomberg that's going to talk about it. Currencies. Who's got the currencies? Dollar. So the euro at 107. I heard talk this morning on Bloomberg TV, 106.73, that the euro could hit parity with the dollar again. That would be a 6% drop in the euro. Massive move. So when we're starting to talk about euro weakening by 6%, US dollar strengthening by 6%, that is a massive move. It reduces European earnings when reported by US companies by that same 6%. It's awful. It's awful. And then if they're doing well, let's say against the Chinese yuan and against the rupee, the Mexican peso, the Canadian dollar, Aussie dollar, next thing you know, U.S. companies are going to have significantly lower earnings. Same business, but it's the translation effect. And so currency, U.S. dollar, going gangbusters. That's rough. Share prices. Now, I noticed something, right? So the momentum was choppy around a much higher base. So we had yesterday 3,021 stocks. Total market cap was $51.5 trillion. Now it's kind of cool to have that, right? $51.5 trillion. Where are we at today, Jeffrey? So as of last night, market close. And by the way, here's a run of all the stocks. This is where the money's at, right? So Jeffrey, where's the money at? The money's right here. Here's all the companies that traded at least 20,000 shares that have a positive beta that are something reasonable. If it's not a stock or if there's some error, you get a 9 in market cap. So you see all those errors in market cap. So we're not going to look at this because that's a tremendous number of anomalies. So I can't tell you where they are today. What I can tell you, though, is over the past year, the return of the S&P 500 has been falling. It's 1137. So it's a 1.6, 1.7 dividend. So you're talking about around a 10% capital return. NASDAQ pays about a 1% dividend. So you're talking about a 21% return on the NASDAQ. But the Russell is flat to negative. The Russell's down 1%. So it says if you're small cap, you haven't been making money this year. If you're S&P 500, you've actually fallen a little bit recently. Maybe you were at a little bit of a high. And so we're still looking at stock prices being choppy. But they rose for the past month or so. Those numbers were all pretty negative not that long ago. Government sales of debt for cash. Last we looked, I just don't feel like looking. It takes too many clicks here. But the Fed continues to do quantitative tightening. The Treasury, which is more fiscal policy, the U.S. Treasury Department, has been refilling the coffers of the Treasury General Account, the TGA. And so the Fed, over 2 weeks, reduced liquidity by $103 billion. Not a ton in a $50 trillion market, but enough to be a headwind. Inflation. Inflation's up. Inflation's up. And I hear a lot of excuses. I heard the Michigan consumer expectations of inflation are a little lower, but truthfully, inflation's up. Inflation's up, and auto gas prices, fuel oil prices up significantly. You're going to see airline prices up. We saw Delta Airlines and American Airlines stock cratering. Let's see if I can pull that up for you. Just a real simple chart. Let's look at, let's zoom in here. Bubbles. We're going to look at industry, airlines. We're going to look at performance. I don't want change today because that's not great. I want to look at, there it is. Let's look at 1 month performance. And they're all negative. The best performer is down 7%. The worst performer is down almost 14%. So airlines are cratering because fuel prices are going up. Fuel prices are going up because oil's going up. And oil's going up because we let Russia and Saudi Arabia control the oil narrative. To be honest with you, we got plenty of oil in the ground in the U.S., but we're not drilling it. The Baker Hughes data has been showing declining oil rig quantities in the U.S. and Canada for a while now. So maybe we could drill some more oil, but for right now, you're not going to drill, then you're going to put your airlines out of business. Great. What else we got? Reserve for future use. Nothing else really was moving here. Bankruptcy filings. We've been seeing anecdotally a few more bankruptcy filings, but that's fine. So net, where are we at? We're at interest rates higher, stock price variance lower, or the VIX lower. The U.S. dollar's higher. Share price is choppy, not much momentum either way. And the government is pulling liquidity out, and inflation's going up. So I look at that, and I think the market would be falling. Now we look, and the market's falling. But you could argue that that's a bias. I'm looking, the market's falling, and so my narrative is negative, but it's not. I put my money where my mouth is, and I'm getting killed because the market's falling. It just is waiting too long. And what else I want to show you? So, couple things. One of them, I made a joke about Amazon. They've got this, the Apple 12, the iPhone 12, which is pretty old now. And I guess it gives off radiation and it fries your head, right? And so what I'm proposing for my friends for Christmas is a mobile dosimeter, which is a Geiger counter and a nuclear radiation detector. This one only trades for $29, comes with free shipping. It's battery powered. I mean, it's nice, right? And so you can operate it in up to 95% humidity. So I was thinking maybe I would take my phone. So I don't have an Apple. I have a Motorola. I love Android. But maybe I can just, wand it with the dosimeter every day and see, maybe there's too much radiation. I know if you're an Apple user, you really got to be careful. You should check for leaking brains, hair falling out, those kind of things. But I heard it's not on the new ones. The new ones with all recycled materials, it's like you're getting a used phone for the price of a new phone. I love that. Used titanium, used copper, used steel. I don't know if they're reusing like the speaker and the earpiece, but hopefully they clean it before you get it. But check it out. You could have a dosimeter for Christmas for $30. Keep your loved ones safe on those Apple products. What else we got? Let's talk about just a few things going on here. And then I can get a little more serious, but I'm loving this, right? What do we got here? So if I look at CNN and I look at the top news, the big news was the automaker strike is different from other ones, but they don't really explain why. So I watched the president speak on this topic, and the president had a pretty interesting view. So you should just check it out. The White House has a video of it, right? You see his face, so stern, so serious. But what he was saying was they got a right to strike. Let them strike. It's okay. Let them strike. Let them get their fair share of wages. Nobody wants a strike, so he's sending 2 people to Detroit. They're going to be hanging out at the Ren Center, I heard, or something like that, or maybe at the Marriott in downtown Detroit, and they're going to be offering their support for negotiations. Now, I don't know about you, but I was a consultant for a very long time, and if the federal government were to send 2 officials to the meetings, I'd be a little bit nervous. I'd want to make my deals a little bit more privately, but this is going to be very interesting. And the talk on Bloomberg about the automotive strike was, it's not so much now, but when they turn over from or convert from internal combustion engine to electric vehicles, that dramatically changes the cost structure of the automaker. And what will that do to the workers? And so I did a little bit of homework and I posted a tweet about it. I don't know if a lot of you follow our Twitter account. We're Chicago Quantum, Chicago_Quantum. But I had a little convo, right? Which is, let's make this bigger so you can see it. Real content, and thank you for BlackRock's Nemesis for engaging me. I appreciate it. So, Ford now makes 12.5% gross profit on vehicles for the last 6 months. And that's up from less than 10%. I want to say it was like 8.5%, 9% last year, same time, same measurement. So 8 to 12, 8.5, 12.5, that's nice. That's big. That's 50% more gross profit. Boom. It's great, right? And maybe that's EV. Maybe that's just customers paying more. I don't know. Now look at Tesla. Tesla's gross margin last year was 30, and now it's under 20. So Tesla's gross margins have shrunk by a third. Now, we know Tesla makes electric vehicles. So if the margin on electric vehicles, when you start to hit mass market, like a Ford, a General Motors, and a Stellantis would be, maybe steady state margins are 15%. Right? I don't know. I mean, they're definitely under 20. If Tesla's going under 20 and Tesla's like so, wow, like Apple, then maybe under 20 is where we're going here. And so now imagine if Ford were to agree, let's say, to pay 10% more wages, 20%. The labor union wants 46% more wages, but let's just say it's 5% a year that they agreed to forever for the infinite future. That's going to cut their gross profit. They're going to raise the price of their vehicles. Of course, they're going to innovate. They're going to market. They're going to have better Super Bowl commercials. But at the end of the day, Ford's probably not going to have better margins than Tesla. And so you're really looking at just a pass-through of cost. But as Ford makes more EVs, I mean, pickup truck is one thing. But are they really going to be more profitable than Tesla? And so, or just charge more than Tesla. So I think this whole Tesla margin shrinking, Ford margins growing, boom, there goes the United Auto Workers trying to take those margins. It's not a good story. Not a good story. And I think this is very interesting. So again, thank you, BlackRock Nemesis, for engaging. Again, if you're If you like it, then check us out on Twitter, on X. We got the U.S. Advanced Computing Infrastructure's logo, but we're Chicago Quantum, at Chicago_Quantum. I think that's pretty cool. We talked about airlines. Let's go talk about quantum computing stocks. I did a survey, and people said they really want to hear about quantum computing industry. They don't necessarily want to hear about any one particular company. And so we are going to, I'm losing my butt right now in the market. Oh my God, is it painful? My goal is not to show you how painful it is, but I'm going to be pretty soon wearing a barrel to do my videos. I don't even know if that's a thing anymore. Do you go over the falls in a barrel or do you wear a barrel? I don't know, but whatever. Maybe I'll wear a Halloween costume. We'll see. But let's take a look at quantum computing, and let's take a look at Bitcoin because I put them all together. So your quantum computing stocks, I'm going to tag them for you here. You've got, well, first off, they're all down, but you got ionq trading at like $3.5 billion. I'm not sure they have any revenue. I'm not sure any of these companies really have revenue. So when you see one of them trading at $3.5 billion, there's a lot of belief going on there. Qubits, which is D-Wave, trading at $1, 145, 147 million. Arcit, they do more of the communication security using quantum photons. That is probably the number one application for quantum computing, quantum technology right now is secure communications. There's a lot of work that's been done over the past really 20 years proving out that you can use photons to secure communications. Think of it like this. You got a wire. You're going to communicate along the wire, right? Think of this as a cable. And now right above the wire, you're going to have a series of photons. And if the photons don't come through, then you know the wire was broken. So it's a second channel that uses photons, or think of it as a quantum link, to tell you whether this link was somehow broken or maybe somebody stole the data. Maybe somebody could put a loop in it. Little loop in it. Oh, look, Jeffrey, I'm going to steal your data and you're not going to know, right? Like think of the submarines where they put the listening device, right? If that happens and they're going to put like a little cable on it, then you're going to know. I get that. Now, if you really want to use photons to communicate and all that good stuff, photons travel really fast, speed of light, but the quantum networks right now, at least last I heard a year ago, were at modem speed. Baud, kilobits. Thousands of bits per second. Thousands. As opposed to trillions, billions, where we are now. And so it's not a fast technology. So that's interesting. Rigetti, we did a thing on Rigetti. We got paid. Thank you, by the way, for the person who paid us. We did a thing on Rigetti, a little analysis, and when they were at 45 cents, they're now at almost $2. And I was able to show that their cost structures come down so much that they're being an effective steward of capital. And they're really working on the kinds of things that could drive quantum advantage. Qubit, which is Quantum Computing Inc., different story altogether, at $1.25, trading about $100 million. And so I look at those, and lots to talk about, but you could buy a little bit of all five of them and just put that money away and say, you know what? They're all working on it. The other big bets here would be, just add them, right? It'd be IBM. It would be Google or Alphabet. Microsoft is investing. It was more simulation. It wasn't really quantum, but I heard rumors that they were spending a little bit of money on some stuff, secret sauce kind of stuff. Alibaba had a little something going on with quantum. Amazon, I don't know if they had their own program or not, or if they were just reselling other people's quantum. Lots of stuff like out of British Telecom. They were doing some interesting things. British Telecom. I don't see British Telecom stock. I don't know if it trades in America. I don't know. Can't find it, so that's fine. Just a little stuff going on, but not much. And so if you look at just these, I mean, you're all down. No one's really getting a lot of revenue. Oh, Honeywell was the other one. Honeywell spun theirs off, though. It's like Honeywell and Cambridge Computing And they spent like $100 million a year on this, and then it just didn't go anywhere. So interesting quantum. You see that no one's really making that bet today on quantum computing. But that's interesting. We like to keep track of that. We're members of the Quantum Economic Development Consortium, albeit we haven't been that active this year. We've been really busy on some other stuff, but it's good stuff. Yeah, if we wanted to get right back in, we could just literally get right back in and be in. We do get asked for our opinion by that government, quasi-government entity, so it's pretty nice. So you can see CNN doesn't have a lot of kind of world news on the business other than the strike. I find that very interesting that there's a labor strike. That's such old news. You know what I mean? It's like old business. So if we look at Rigetti, where are we at for a month? You can see it came down pretty flat. We liked Rigetti at 45 cents. We thought it was terrific. ionq, you can see 13, kind of popped to 20, back down. A lot of short squeeze action going on in this market, which actually makes us very nervous. It's not necessarily a safe market. It's a dirty market when it's squeezing. So what else? What else do you want to talk about? Anyone got anything for the chats? Not seeing anything on the chats. So maybe I'll share a little bit for those who kind of listen in and watch. So one of the other things that we do, so we run our model, and you can see expected market return is under 7%. And so momentum plays a big part of our model. If stocks have been going up for the past year, they're more likely to keep going up. If stocks go down, they're more likely to keep going down. We do believe that the trend is your friend, and our model kind of acts that way. But it's really just in setting the stage, and we will moderate this. But right now, your expected market return is 7% over the risk-free rate of return of 5.5%. So you're looking at, if you held all the stocks, you're looking at an expected return of 13.75%. Now, I've seen that risk premium over risk-free as low as 1.2% recently. And so you've had the market go up, right? Because it kind of bought the dip. That's one interesting thing. The second thing that does, and you can see that the stock price variance is so much lower. So what's interesting is a high return with low variance really turbocharges new money going into the market. We look at like the top, 20 stocks from our model, and you see they're pretty risky. These are not like the Teslas of the world. This is Cardlytics, Skills, gaming companies, if you don't know them, Unity, digital media companies, Wayfair, e-commerce, Digital Turbine, enabling monetization, Affirm, subprime lending for consumers on the internet, Open Door Technologies, software enablement, Lending Tree, subprime and prime, mortgage lender, Q-Rate Retail. I don't know if they ever recovered from their fire, but they do e-commerce, Block, e-commerce, Caesars Entertainment for gambling. So, Marathon, Bitcoin miner. So you can see what's hot right now is the most risky parts of our market. But the edges are smaller. Oh, and TNA is so interesting. There's an ETF that our model just loves to death. TNA. It's a small cap bull 3x shares. Because if all these small cap bulls are going up, then imagine getting triple the return. That's awesome. Love it. The other thing that was interesting, though, is when you look at what the model was picking, and we're having the model run pretty hard these days. Not quite as hard as we used to, but pretty hard. What you're finding is I want to show you where the market's ending up. The best pick is like 14 and a half basis point, or I'd call it 14 and a half ticks of alpha or edge. 14, 13 and a half, 13. So if you want to buy 2 stocks to 8 stocks, you're really at 13 to 15 ticks of alpha. That same comparison a week ago was 24 ticks. Now it's 14 ticks. So that's rough. That's rough. Do I even show that? No, I have it somewhere else. You have to find that somewhere else. So ticks of alpha might end up being one of our factors, but it's so proprietary, it's so kind of edgy that it's hard. But what this says is, if you're out there to take a risk, there's less gain out there from buying all this crap, right? You want to put your money in Cardlytics, Affirm Holdings, Digital Turbine, Checkpoint Technologies, Open Technologies, PACW, and the 3X Stonk ETF play. You're going to get 13 ticks of alpha. It's just not a lot. I've seen it much lower, so don't get me wrong. This is still an optimistic risk-on market. But you've got like half the edge than you did a week ago. So the market's kind of run through this reduction in volatility. But we still see volatility lower, and so we're really struggling with this. This is really the question is, I'll type it for you. The real kind of key takeaway is that you have expected returns to risk are lower. You have market risk is lower. Continues to drop. So what do you do? When's it going to break? Well, what breaks this, right? What breaks it? What breaks this Goldilocks scenario? So expected returns to risk are lower, but still high at, like around 7%. So what breaks? What breaks is an interest rate hike next week from the Fed and the ECB and from the Japan Central Bank. What breaks it is recession signal. What breaks it is war. But I'm not seeing any inflation surge. I'm not seeing any of that. Big bankruptcies or layoffs, not seeing that. We're in a Goldilocks scenario. And so it sure feels like a soft landing. Just looking at core data, right? We see interest rates flat but elevated. I get it, but so does everybody else. We see job strength. I don't know. We don't see anything. And so as a result, market isn't falling. I bet you we fade this decline into the close, and you're not going to see a dramatic drop or shock. I just don't see it. I don't see any reason why the market should fall in terms of just quantitative data. So there's others, though, that like to look at other things. And so there's platykurtic stocks that are non-normal. There's leptokurtic stocks that are not normal. Tend to be very low risk. Johnson & Johnson shows up on that list. We have negative skew stocks. For those who like to bet that the past repeats itself, and the stocks that drop more days than they go up will continue to drop more than they go up. Some of those names are familiar. And then you have stocks that are, excessive positive skew, like Mullen, right? Real meme, kind of weird stocks that go up and down a lot, like JagX, which is a tiny cap that our model hates. EJH, again, tiny cap that our model hates. Checkpoint, you notice it's one of the model stocks that our model loves, birds. That's crashed and burned. A significant positive skew to birds. They make the bicycles that people may not want to pay for. Cosm, tiny, tiny, tiny cap stock that's really been in the toilet. But again, positive skew. And so, Madrigal, a pharmaceutical company that's gone up like gangbusters. It was like the #1 gaining stock a month ago for a year. Significant positive skew. The thing went up, 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 right? Where's it today? So when you look at positive skew stocks, a lot of them have a story, right? And so that's cool. You get a list of like, I don't know, 32 of them out of 3,000. You could kind of put your whole strategy around 32 dogs. Just interesting. And the other thing that's interesting, if we go to the very top, we talked about the 50 stocks with the best score. I'm going to very quickly go by the worst score. Here's the stocks with the biggest price rise over the past year. Now, Faraday Future Intelligent Electric is like a memed kind of stock, but ionq has been up. So the question is, what drove ionq up? What drove the used car company Carvana up? What drove AppLovin up? What drove National Cinemedia, which is a competitor to AMC, up? I don't know. Interesting. Those stocks are up like 200%. Okay, largest beta stocks. What's making these stocks move with the market, right? And smallest beta. Now, it makes sense that 1 to 3 year Treasury bond ETF wouldn't move with the market, right? It's not. But it's interesting to see that the 20 to 30 year bond, the 20-year bond, 20-year maturity and more, or duration bonds, they have a 15% positive correlation to the market. That's more than I remember seeing. Gold now has a stronger 23% correlation to the market, to equity markets. It's interesting to see gold moving more with stocks. And then you see what the model's been picking, right? Which is a lot of dog stocks. So there you have it, right? Lots of interesting things in the market, lots of anomalies. Market's finally having a down day, but you really didn't see that. You look at the dollar, right? Today it's up, but at one point this morning, so interesting. Or yesterday, it was 106.5. Now it's 106.7, and here it is. So I want to thank you for watching. Appreciate it. You see the quantum stocks are down, the Bitcoin stocks are down, the risky stocks are down, and interest rates, we're just not seeing it. Interest rates are, there's a lot going on here. So, all right, thank you for watching. I was just going to say the yield at 4.31 is slightly higher on the 10-year, which we called before, and 4.4 for the 30. These are very material. And so, yeah, good luck. Take care now. Bye-bye.